The retail automotive sector moves over $1.3 trillion annually, yet the average franchise operates on a razor-thin net margin of just 1.5%. In today's high-interest economy, a single unsold car drains $85 a day in floor plan carrying costs, transforming a shiny showroom into a violent capital grinder. The myth of the wealthy local dealer retiring at 50 is a carefully polished illusion. Here is the problem. Almost none of what you think you know about this business is actually true. And this financial tragedy does not begin with dry numbers on some macro balance sheet. If you are tired of shallow, get-rich-quick formulas and want to master the rules of big money, hit the subscribe button right now to join us in decoding the next financial homicides. Imagine you are 42 years old, a former vice president of enterprise sales who spent over 2 decades navigating the corporate labyrinth. You did everything right, eventually accumulating $1.2 million in your retirement savings. But that relentless corporate grind wears down even the most resilient executives. And like many high earners, you wanted to transition from a corporate employee to a true asset owner. When a legacy regional automotive franchise became available, it seemed like the ultimate wealth-generating machine. The physical presence of the dealership was breathtaking. A high-ceilinged glass showroom reflecting the sun, rows of pristine, brand-new vehicles parked across 4 acres of prime commercial real estate, and a steady stream of buyers walking through the glass doors. On paper, the mathematical model looked completely bulletproof. The store was projected to generate a massive $45 million in gross annual revenue. Looking at the historical seller's discretionary earnings, you calculated a highly lucrative cash flow cushion that would easily replace your corporate executive salary, comfortably pay down your monthly debt service, and fund an early retirement. It was the classic glittering picture of American business success. But this is where the critical error occurs for most aspiring operators. In corporate finance, there is a vast, dangerous chasm between gross top-line revenue and actual distributable cash flow. A flashy physical showroom and a high volume of moving inventory can easily mask a structurally terminal operation. Valuing any business based on the sheer scale of its infrastructure or its top-line vanity metrics is the fastest way to commit financial suicide. The rolling metal on the lot looks like wealth, but without a deep forensic audit, you cannot see the silent friction. And you didn't know that the moment you signed that franchise agreement, you were stepping into a liquidity trap so perfectly designed that there was no turning back. The first morning you unlocked the heavy glass doors of your newly acquired dealership, you felt that intoxicating rush of ownership. On the pristine lot sat 150 vehicles, their polished chrome catching the morning light. What you did not realize was that you did not actually own those cars. In the automotive retail sector, almost no one buys their inventory with cash. Instead, you are introduced to the brutal mechanics of floor plan financing. This is a massive, highly leveraged revolving line of credit where a commercial lender fronts 95% of the wholesale invoice price of every vehicle shipped from the manufacturer. This credit line is not cheap, and it's certainly not stable. Because your floor plan was structured on a floating interest rate pegged to the Secured Overnight Financing Rate, or SOFR, plus a 3.2% risk spread, you were suddenly exposed to the raw volatility of federal monetary policy. In a high interest rate environment, this pushed your annual borrowing costs to a punishing 8.5%. For every $40,000 SUV sitting on your lot, you are paying a compounding interest fee directly to your lender, regardless of whether a single customer walked through the doors. This interest cost is only the baseline of a metric known as the daily holding cost. When you factor in commercial lot insurance to protect the vehicles from hailstorms and theft, physical security, lot maintenance, detailing, and the relentless non-linear depreciation of modern machinery, the actual carrying cost of a single vehicle on your lot rose to exactly $72.50 per day. Now, let's run the forensic math. $72.50 multiplied by 150 vehicles equals $10,875. Every single day, whether the weather is clear or rainy, whether the showroom is packed or completely empty, you are watching $10,875 of pure liquidity drained straight out of your operating account. This is not a paper loss. This is cash fleeing your bank ledger in real time. And then the hidden trap door of the industry snaps shut. It's called the curtailment clause. Commercial lenders don't allow dealers to hold on to depreciating inventory forever on their dime. Under your floor plan agreement, the moment the vehicle remains unsold past 90 days, the curtailment clause is automatically triggered. When this happens, the lender forces the dealer to immediately pay down 10% of the principal wholesale value of that specific vehicle using their own cash reserves.
Think about the operational math behind this pressure. If you have just 10 heavy-duty trucks priced at $50,000 each that fail to sell within 3 months, you are legally forced to write a physical check of $50,000 to the bank to pay down the principal on those aging vehicles. This is money paid out of pocket for inventory that is still sitting on your lot, losing value every minute. Suddenly, you are trapped in a devastating spiral. As the market slows, your sales volume drops, your holding costs accumulate, and the wave of impending curtailment payments begins to hollow out your remaining capital reserves. You are realizing the ultimate lesson of leveraged retail assets. Inventory is not neutral on your balance sheet. It is a bleeding asset, a ticking financial time bomb that demands constant cash to keep from exploding. When car sales slow down and floor plan debt costs threaten to blow up your life savings, you are forced to strip down the dealership structure to look for hidden under-the-table lifelines. To survive a compounding cash flow hemorrhage, you had to completely abandon the naive belief that a car dealership makes its money by selling cars. In modern automotive retail, the physical vehicle on the showroom floor is not a primary profit center. It is a highly optimized customer acquisition tool. It is the bait. The true financial engine of a dealership hums quietly in 2 areas of the physical building that the average consumer rarely associates with wealth creation. The first of these operations is the Finance and Insurance Office, universally known as the F&I department. While customers believe they are simply signing registration papers, this single office quietly generates over 35% of a dealership's entire gross profit. The mechanics are beautifully clinical. When a buyer decides to finance their purchase, the dealership does not merely act as an intermediary. The partner financial institution provides you with a wholesale interest rate, technically known as the buy rate. If the bank evaluates a buyer's credit risk and offers a buy rate of 6.2%, you are legally permitted to mark up that rate before presenting the contract. You present the buyer with an 8.2% rate. The buyer signs, and you quietly pocket the 2 percentage point spread. This interest rate markup, known in the industry as dealer reserve, is pure, friction-free profit conjured entirely from paper. But the F&I office does not stop there. The real wealth is buried in high-margin back-end add-ons, specifically vehicle service contracts or extended warranties, alongside guaranteed asset protection, known as gap insurance. You buy these protection packages wholesale from third-party administrators for roughly $1,200. Your finance managers then present them to exhausted, risk-averse buyers for $3,000. This represents an incredible 150% markup on an intangible product. When a well-run F&I department achieves a high attachment rate on these contracts, the dealership effectively transitions from a low-margin retail store into a highly lucrative financial services firm. Yet, even the paper profits of the finance office cannot match the ultimate defensive fortress of the dealership: fixed operations. This comprises the service bays, the parts department, and the collision center. While selling a new vehicle yields a volatile single-digit net margin, the service bays operate on a massive gross margin of 48% on combined parts and labor. This is where you confront the brutal reality of fixed cost rigidity. Your lease, property taxes, administrative payroll, and utility bills remain completely static regardless of how many cars are sold. To neutralize this structural rigidity, elite operators obsess over a single critical metric: the service absorption rate. Teacher voice: the service absorption rate measures what percentage of a dealership's entire fixed monthly overhead is covered solely by the gross profit generated in parts and service. When you can optimize your service department to achieve a 100% absorption rate, a profound structural shift occurs. The parts and service department completely covers the rent, the utilities, the executive salaries, and the property taxes. Once that threshold is crossed, every single vehicle sold on the showroom floor and every warranty attached in the F&I office becomes pure, unencumbered net profit, because the physical building's operational costs are already paid for by the mechanic's wrench. The dealership is no longer a fragile retail business vulnerable to consumer mood swings. It becomes an incredibly resilient cash-generating machine. But are these clever mathematical calculations enough to protect a single isolated dealership from macroeconomic storms? Or is scale the ultimate arbiter of survival? To understand the brutal gravity of your situation, we must step away from individual balance sheets and examine a corporate homicide that sent shockwaves through the American credit market. In April 2023, U.S. Auto Sales, a major pre-owned dealership chain operating 39 locations across the United States, abruptly and completely suspended its entire retail operation. This was not a slow, visible decline. It was a sudden, systemic cardiac arrest that left thousands of vehicles stranded on locked lots and hundreds of employees instantly terminated.
When forensic auditors dissected the carcass of U.S. Auto Sales, they discovered the exact same financial pathogen that was currently eating you alive: a terminal asset-liability mismatch. An asset-liability mismatch occurs when a business funds long-term illiquid assets, specifically a massive inventory of depreciating vehicles sitting on concrete lots, using highly volatile short-term floating rate debt. For years, when the Federal Reserve kept benchmark interest rates near zero, this mismatch was masked by cheap money. Dealership chains borrowed aggressively on their floor plans, and the yield spread between what they paid for inventory credit and what they earned from auto loans in the finance office was highly profitable. But when inflation surged and the Federal Reserve executed its most aggressive rate tightening cycle in 40 years, the cost of capital skyrocketed. The benchmark lending rates surged, dragging the cost of floor plan financing up to nearly 9%. Simultaneously, the consumer credit market began to freeze. Subprime and near-prime buyers, the lifeblood of used car operations, were hit by inflation and could no longer qualify for auto loans. This is where the leverage cut in both directions. The inflow of cash from the finance office slowed to a trickle, but the outflow of interest payments to the floor plan lenders did not slow down. It accelerated. U.S. Auto Sales was suddenly hemorrhaging millions of dollars every single week just to maintain the physical right to hold their inventory, when their primary line of credit was completely frozen by lenders who realized the underlying collateral was depreciating faster than the loans could be serviced. The entire 39-store empire collapsed into bankruptcy within a matter of days. This dramatic collapse highlights the deep structural trade-offs of scale in the automotive retail sector. The common assumption is that scaling up is the ultimate defensive shield. But in a highly leveraged industry, scaling up without a complete restructuring of your capital stack simply builds a larger, more fragile tower. Consider the operational differences between your single-store operation and a larger multi-store chain. At a small scale, you face extreme micro-level friction. You lack any meaningful bargaining power with the legacy software monopolies that control dealer management systems. You are forced to pay an unnegotiable $4,500 a month just to run your inventory and customer databases. Furthermore, because your volume is low, you cannot self-insure or absorb a sudden run of bad vehicle service claims. meaning you are entirely dependent on third-party administrators who skim the majority of your F&I margin. However, you possess a level of tactical agility that a giant chain lacks. When a bad month hits, you can personally walk onto the sales floor, renegotiate local vendor contracts, downsize your variable marketing spend in 48 hours, and cut non-essential payroll to keep your fixed overhead low. A massive dealer group, on the other hand, enjoys immense economies of scale. They can negotiate bulk pricing on software, share a centralized accounting department across 20 locations, and pool their finance contracts to set up incredibly lucrative tax-advantaged reinsurance companies in places like Nevis. But when a credit freeze occurs, these massive dealer groups lose all operational agility. Their fixed overhead is incredibly rigid, locked into long-term commercial real estate leases with mandatory annual escalations and aggressive corporate payroll commitments. When interest rates climb and sales volume drops, a large group does not just lose money, they burn through liquidity on a systemic scale. A giant dealer group can easily burn through $5 million of pure cash in a single month of slow sales. In the game of leverage, the bigger the balance sheet, the faster the descent. Realizing you were standing on the precipice of a terminal cash flow crisis identical to the US auto sales collapse, you were forced to execute a radical forensic restructuring of your entire business model. To survive the crushing gravitational pull of systemic debt, you had to evolve from a vulnerable retail manager into a cold, calculated architect of assets. You realize that true wealth is not generated by sweating over daily operations under the flickering lights of a showroom. It is built by entirely decoupling the operating business from the underlying property and routing the transactional profits through highly optimized legal tax havens. First, you executed a classic corporate partition, splitting your business into two completely separate entities, an operating company, or OpCo, and a property company, known as PropCo. You transferred the title of the multi-million-dollar commercial real estate into your newly formed PropCo. Then you leased the land back to your own OpCo, which ran the dealership, at a premium rental rate. By doing this, you protected the physical land from any operational liabilities or lawsuits faced by the dealership. You also successfully converted highly taxed business operational income into real estate rental revenues, unlocking massive depreciation write-offs that dramatically minimized your personal income tax exposure. Next, you address the massive margins being captured in your finance and insurance office. Instead of selling extended warranties for a simple one-time commission from third-party administrators, you incorporated your own captive reinsurance company, domiciled in the highly regulated, tax-optimized jurisdiction of Nevis. Now, when a buyer purchased a vehicle service contract at your dealership, the premium did not vanish into a manufacturer's vault. The cash was routed directly into your offshore insurance firm. Under the United States Internal Revenue Code Section 831B, small insurance companies can elect to be taxed solely on their investment income, completely exempting their underwriting profits from federal income tax up to an annual limit in the millions. The cash sitting inside Nevis did not remain idle either. It was quietly reinvested into conservative global equities, compounding entirely tax-free. Finally, you stabilized your operational balance sheet. You aggressively negotiated your commercial leases to include co-tenancy clauses and capped your common area maintenance, or CAM, fees to keep your fixed cost rigidity to an absolute minimum. You trimmed your dependency on floor plan leverage, keeping cash reserves on hand to purchase aged used inventory outright, avoiding the compound interest trap entirely. This is just an illustrative example to help you understand the power of long-term compounding. Your actual results will depend on your income, expenses, returns, and investment choices. Because ultimately, the difference between a stressed business operator drowning in monthly debt service and a true sovereign asset owner lies entirely in who understands the rules of the game first. The lesson of this journey is not an isolated warning for the retail automotive sector. It is a universal blueprint for modern commercial survival. Whether you are scaling a venture-backed technology startup, negotiating a commercial lease for a metropolitan retail store,
or evaluating a logistics fleet franchise, the fundamental laws of asset management remain completely unchanged. If you do not master the precise mechanics of your cash flow, read the fine print on floating interest rates, and neutralize your fixed cost rigidity, you are not building a sovereign business. You're simply constructing a highly elaborate leveraged trap for your own capital. How does your current asset portfolio measure up against these hidden structural costs? Which multi-billion-dollar asset class or corporate ecosystem do you want us to dissect under our financial forensics lens next? Leave your thoughts in the comments below. Do not forget to like this video, subscribe to Asset Forensics, and share this analysis with those who are preparing to deploy their hard-earned capital into the market.